Investing. Not investing is one of the biggest mistakes you can make with your money. It is one of the most important tools to get ahead financially. If your money is just sitting in your bank account, inflation is likely deflating the buying power of your money. For example, having $10 5 years ago got you more than what $10 can today. When investing, a good practice is to pay yourself first. Before you start spending your paycheck, set aside a certain amount, for example, 10% to invest into an index fund like the S&P 500. This is a great way to start investing. It diversifies your investments and also utilizes a common investing strategy known as dollar cost averaging. You have some pretty amazing returns over the life of those investments thanks to compound interest, which Albert Einstein refers to as the eighth wonder of the world. Compound interest grows tremendously over time and will make you very wealthy if you understand it. Here are some great books on investing. Now, you might wonder, what is the point of investing? Retirement. Not investing in your retirement is a really bad mistake a lot of people make and is often overlooked until it is too late. You must put money aside for your retirement so you can enjoy the end of your life after all your hard work. The sooner you get started, the better. Going back to compound interest for a second, let's look at the powers of compound interest and the simple investment strategy I explained earlier. Here are Timmy and Joe. Timmy started investing $5,000 a year from 25 years old to 65 when he retired. And Joe started investing $10,000 a year from 45 years old to 65. Both of them invested $200,000 over their working years and averaged a return of 10% in the S&P 500. By the time they retired, Timmy was living comfortably with over $2 million, and Joe has just $600,000 even though he invested the same amount. On the topic of saving money, the next mistake to avoid is overspending. Overspending often roots from keeping up with the Joneses, the Kardashians, or whoever you're trying to impress. Many people feel pressure from society because of all the flashy cars, houses, and yachts full of models on Instagram. While I'm not saying it isn't nice to have, you should evaluate each purchase you make and decide whether you really need it or if you're just trying to impress somebody. Needless to say, these are all mostly wastes of money and have cheaper alternatives, which I recommend until you are financially free. Get the cheapest and most reliable car you can. Live in the minimal amount of house that you need, whether it be with roommates or even with your parents, and spend within your means until you need to spend more. Which takes me to the next mistake, credit cards. Credit cards can create costly mistakes if not used correctly. Now, don't get me wrong, credit cards can be a great tool for the few people who are financially responsible with them. But like I said, there are a few people like that, so avoid them if you don't know what you're doing with them. They have super high interest rates. And if you remember what we said earlier about compound interest, it's really bad when it's working against you. So if you are going to use a credit card for the points and to build your credit score, that's very smart. But make sure you pay off the full amount every month and on time. Even if you are perfect with your credit card, sometimes emergencies come up. That's why you need to avoid this mistake next. Emergency funds. Not having an emergency fund is asking for trouble. Life is unpredictable, and emergencies can happen at any time. Whether it's an unexpected home repair or sudden job loss, having an emergency fund ensures that you're financially prepared to handle these situations without resorting to high-interest debt or draining your savings meant for other goals, which is the start of big financial problems in the long run. Having an emergency fund allows you to avoid falling into this debt trap and provides stability during times of uncertainty. Start your emergency fund by setting a specific savings goal, such as 3 to 6 months worth of living expenses, and then commit to regularly contributing to your emergency fund until you reach that target. Keep that money separate from your investments. A good place for this is a high-interest saving account, which many banks offer. You can automate your savings by setting up automatic transfers from your paycheck or checking account to your emergency fund to ensure consistent contributions. While emergency funds are essential to protect you in minor unforeseen situations, they don't protect you from major emergencies, leading me to not having insurance. Insurance serves as an essential addition to emergency funds, protecting you from large financial risks that may exceed the amount of what an emergency fund can cover. Insurance helps protect you from the risks associated with unexpected events that can cause significant financial loss, from bad auto accidents to major damage to your house. It's important to mention health insurance, which, if applicable to you, can help cover some really expensive medical treatments and hospital bills. In many cases, insurance coverage is required by law. For example, auto insurance is mandatory in most places to legally operate a vehicle on public roads. Similarly, homeowners insurance may be required by mortgage lenders as a condition of obtaining a loan to purchase a home. Not having insurance will put you in some serious financial hardship in an emergency, and not to mention can result in legal penalties and financial liabilities. By having the right insurance coverage in place, you can safeguard your financial well-being and protect yourself and your loved ones from potentially devastating unforeseen events. It's impossible to predict the future, and that's why being prepared is a big part of avoiding many financial mistakes. But to be prepared, you have to be informed. Financial literacy. Financial literacy is the foundation of wealth. If you're watching this video, that means you're in the right mindset to learn, so good job. Unfortunately, money is a little more complicated than what one short video can explain. But luckily for you, YouTube is full of financial education from some very smart individuals. Make sure you are aware of your local bank accounts and take advantage of any tax-free savings accounts, retirement accounts, and any other resources available to you. Read books, or if you're lazy like me, watch book summaries on YouTube about things like investing and budgeting. Learn the skills necessary to understand financial concepts, budget effectively, save and invest wisely, and master your finances. Without financial literacy, it's hard to make informed decisions about your money, which can lead to financial stress, debt, and missed opportunities for wealth. Now it's time to address the biggest factor impacting your finances: earning potential. The biggest mistake people make is not investing in themselves and increasing their earning potential. This one thing alone makes every other financial mistake we just discussed so much easier to avoid. By developing new skills or refining old ones, you can enhance your value in the job market and gain higher income opportunities. Just as you learn financial literacy tips, actively seeking ways to increase your earning potential is crucial. Utilize resources like YouTube, online courses, or professional development opportunities to acquire new skills or certifications. Whether it means pursuing a higher paying job, starting a side hustle, or taking on an extra job, investing in your earning potential opens up avenues for greater financial stability and success. Remember, the higher your income, the more you'll be able to save, invest, and ultimately set yourself up for long-term wealth accumulation and financial freedom. If you found any of these valuable, please subscribe and let me know what you want me to explain next in the comments below.